ऐसे में बड़ा सख्त लौंडा हूं, लेकिन यार यहां में पिघल गया।
तो चलिए शुरू करते हैं।
Hello friends, welcome to Screen Guru, and in today's lecture we'll be discussing the remaining topics from chapter 1 of National Income Accounting. So today we'll be discussing some really hot topics which can come in your examination. So please stay tuned with us and have a nice day. Now let us focus on real GDP, nominal GDP and GDP deflator. Okay, so these three topics are really important and you have to read the topics from your NCERTs for better understanding, okay, because they have provided this with examples also here. So let me give you an idea of what it is. So real GDP is a GDP calculated at constant price by setting a base year. So what exactly does that mean? When we are calculating GDP, we are calculating it on the assumption that the price of goods and services do not change during the period of our study. So basically we consider the price of goods and services to remain the same within the year of study. Okay, say for example, like how I said, now we are using base year 2011-12, which means for calculating GDP we are still using the price of commodities in the year 2011 and 12, and we are not using the price of commodities in the year 2020-21. Okay, so that is one important thing we have to note when you are calculating real GDP. So real GDP gives a figure of GDP at constant price by setting a base year. So if the price changes, then there will be difficulty in calculating and comparing GDPs. So that is a reason why we don't, take the current price of goods and services. And if we measure the GDP of a country in 2 consecutive years and see that the figure for GDP of the later year is twice that of the previous year, we may end up concluding that the volume of production of the country has doubled. But it is possible that only prices of all the goods and services have doubled between the 2 years. Okay, whereas the production has remained constant. So that can also happen, wherein if we are taking the nominal GDP, like the GDP at current prices, we might end up overestimating GDP because production must not have gone up, wherein only the prices would have gone up. So we don't want to see the prices going up, instead we want to see the production going up. So if you want to calculate the production of a country, we have to calculate the real GDP. So what is nominal GDP? Nominal GDP is GDP at current price. So if you are taking a basket of goods and if you are like multiplying the basket of goods with the prices in today, then we are calculating nominal GDP. So that obviously will differ and will be really high compared to real GDP. So GDP deflator is the ratio of GDP nominal and GDP real. And why is it so significant? It is significant because it gives us an understanding of the price rise and also understanding of the increase in the volume of production. GDP deflator gives us an idea of the price rise in the economy along with the rise of production also. But other than GDP deflator, there is also a tool called the CPI or the Consumer Price Index that will give us an idea of the price rise or the change of price in the economy. Okay, for calculating consumer price, we have to have a set of representative consumers, that is a normal household, and a basket of goods which includes the kind of goods that a normal household will consume. The vegetables, the clothes and everything will be included in that basket of goods. So that basket of goods would remain constant for any number of years. So when you're calculating CPI, we will not be accounting the improvement or the increase in production, but we'll be taking just the price rise. Okay, so how do you calculate CPI? For that, we have to consider like a representative consumer who buys 90 kg of rice and 5 pieces of cloth in a year to 1000 for rupees 10 and 100 respectively. So in total it would cost him like 1400 rupees to buy the entire thing in 2000, the year 2000. Say for example 5 years down the line in 2005, he has to pay 15 rupees for rice and 120 rupee for the piece of cloth. So in the end he'll have to pay 1950 rupees in the year 2005. So it shows the increase in price of the quantities. Okay, the same amount of goods, but the prices have been increased. So CPI can be calculated by dividing the later by the former, and this will give the CPI of the basket of goods that we accounted for calculation. Similarly, CPI will give you an idea of the normal household, wherein wholesale price index will give you an idea of the firm's purchase. So if a firm is buying raw material, that will bulk purchase and everything will come under wholesale price index. For that they have a different basket of goods and a different representative consumer. So how is it different from GDP deflator, the CPA and WPI? So here we have to see that the GDP deflator takes into account of all the goods and services produced in the country, wherein CPI will take into account only a basket of goods into consideration. Okay, and GDP deflator will not include the goods that are imported. That is one main point, wherein CPI means it is the goods that are consumed by us, the consumers. So we will also be consuming imported goods. So CPI will calculate that also. The GDP deflator, on the other hand, will weigh the changes every year, okay, based on the production level. So GDP deflator will have this weightage for production also, wherein the weightage will remain the same for CPI. Weightage means the amount of goods and services produced in a country. So that will keep on increasing, and that will be shown in GDP deflator. Where in CPI we have a basket of good which is fixed, so we cannot do anything about the weight of the production. So that we will not be considering when we are calculating CPI. So these are the basic differences that we have to know. So this brings us to the end of the first chapter. So this will be our last topic, and then subsequent section we'll be discussing mock test from first chapter, and we'll be discussing the previously asked questions from this first chapter. Let us do a final topic, that is potential GDP versus actual GDP or real GDP. So for our understanding, we will consider real GDP and actual GDP being the same. So it is the actual GDP of the country, wherein potential GDP is a hypothetical model of GDP estimation, where we consider economy is going in its full potential, which means all the labor force in the country are participating, means everyone are employed, and all the capital is being utilized fully to its fullest, wherein there is no strikes, there is no lockdowns, there is everyone is participating, and we have to consider that there is a constant inflation. When all these things happen, we can see that the economy or the GDP will keep on rising and will not come down. So such a hypothetical model of GDP calculation is called potential GDP, wherein actual or real GDP gives us the idea of what the GDP of a country looks like normally. Okay, because that is being compiled from the data that we collect from firms and everywhere, wherein potential GDP doesn't have a data source. So it's just a hypothetical model. So what is the benefit of potential GDP estimation? So it will give you an understanding of the deviation in the economy. Okay, so the output gap, as I've mentioned, it is the difference between the real GDP and potential GDP. Output gap being positive means the actual GDP of the country growing above potential GDP, and output gap being negative means the actual GDP of the country coming below the potential GDP. So when output gap is positive, it will give an inflationary trend to the economy. So inflation we'll be discussing later in detail, but for your understanding, inflation is a persistent rise in price in the economy, which means like if today one apple costs 10 rupee, tomorrow it can cost 20. Day after tomorrow, if it again comes back to 10 rupee, it is not inflation. So that price rise has to be persistent, because like day after tomorrow it has to be 30, then 40, then 50. So it has to keep on increasing, only then we can say that the economy is in inflation. So potential GDP helps us to see that thing, and potential GDP or the output gap, when the output gap becomes negative, we can see the recession trend. Okay, so likewise this pandemic recession, we can trace it like beautifully using, when we are comparing potential GDP and actual GDP. So that is how we can make use of output gap. And we have to consider that when you are calculating potential GDP, we will be considering inflation to be constant. But when actual GDP, inflation will keep on varying, because if actual in potential GDP, if it is not considered constant, then we will not be able to map the model of economy at that for that particular year. So the constant inflation is adjusted and on a quarterly basis using the GDP from the real GDP. So these are the differences between the potential and the actual GDP. So in the coming session, we'll be seeing all the possible questions that can come from this one single chapter, and we'll also discuss the previously asked questions from this topic. Okay, so it will give you an overall idea of how to prepare for this first chapter and the kind of questions that you will be getting from the first chapter. Hoping that you all have enjoyed my session, and thank you and have a nice day. Like I said, in our next session, I'll be providing you the handwritten notes for this particular chapter, which you can utilize to make your study easy. Okay, so thank you and have a nice day, friends.
2,000 years later.
So please whatever. Please I want to reach 1 million.